Hello everyone, welcome to UPSC Economics by Rohit Lal. So in this video today we're going to understand the concept of what are treasury bills. So treasury bills firstly are money market instruments. Now because treasury bills are money market instruments, they are going to enable the government to borrow for short term duration of time which is less than 1 year. Now let us understand why the government needs to use treasury bills. The key reason is that the government earns revenues through different direct and indirect taxes such as GST or for example income tax. However, these earnings of the government are periodical in nature. For example, GST collections happen on a monthly basis. On the other hand, income tax filings are done by different entities on a quarterly basis. However, if you talk about the spending of the government needs to incur expenditure on a daily basis because the government needs to pay salaries of different personnel it has employed, be it police, be it teachers. The government needs to incur different form of subsidy expenditure. We know that the government subsidizes fuel, fertilizer and even rations for the economically weaker sections of society. Also, the government needs to, for example, incur expenditure on military upkeep. The government needs to pay for the rations, the government needs to pay for the fuel. So because the government has to incur expenditure on a daily basis and the government is going to receive income at different points of time, there may arise different situations where the government may witness a temporary shortfall of liquid cash, and in order to bridge those short term liquidity mismatches, the government can borrow via treasury bills. So treasury bills are mechanisms which are allowing the government to borrow for a short term duration of time. So let us now understand some of the features of treasury bills. So firstly, treasury bills are issued by the central government and it is RBI which issues treasury bills on behalf of the government. And the way RBI issues treasury bills is that it conducts an auction for helping the government raise money via treasury bills. Let's say the government requires 1,000 crores via treasury bills. So what the RBI is going to do is that it is going to invite bids from different investors who want to invest in treasury bills. Let's say you have three broad category of investors such as banks, mutual funds, investment institutions, and let's say RBI is issuing treasury bills which have a face value, that is on maturity these treasury bills are going to pay the investor 100 rupees. Now the RBI is going to ask these different investors at what price they wish to buy these treasury bills right now. Let's say you have a category of investors who are like they're willing to pay 99 right now to get 100 in the future. Similarly, B category may say that they're willing to pay 98 to get 100, and C category may say that they're willing to pay 97 to get 100. So what you are witnessing out here is that A category of investors are okay with the lowest possible returns, whereas C category of investors relatively want a higher level of return. So what RBI is going to do is that RBI is going to select bids up to which it is able to raise 1,000 crores. So let's say RBI has multiple investors who've bid for category A, which is they're willing to pay 99 to get 100, and there are multiple B category of investors who are willing to pay 98 to get 100 in the future. Now if RBI is able to raise 1,000 crores via these category of A and B investors, then RBI is going to reject the bids of C category of investors and the RBI is going to enable the government to raise 1,000 crores via A and B category of bids. So what you're witnessing out here is that these treasury bills are being bought at a cheaper price and the investor is getting the full price on maturity. Therefore, these treasury bills are called as discounted securities because let's say you're buying them at a discounted price of 99 and you're getting the full price of 100 on maturity. Treasury bills are also called as zero coupon securities, and the reason is that these treasury bills are not paying any interest to the investor. Typically what happens is that if someone lends money, say via bond, and let's say there is a bond having a value of 100, interest of 10%, and for 2 years, so that bond is going to pay interest income of rupees 10 in the first year, and it is going to pay the total value, which is 10 rupees of interest plus 100 rupees of principal, which is 110 in the second year. So typically a bond pays interest return to the investor. However, treasury bills are zero coupon securities and they do not pay any interest. They are issued at a price, at a lesser price or at a discounted price, and the investor gets the full value on maturity. Now the other thing to remember about treasury bills is that state governments are not allowed to issue treasury bills, and it is only the central government which can issue treasury bills. Also, treasury bills can be issued for three broad denominations, which are 91 days, 182 days and 364 days. Finally, treasury bills have a very high level of liquidity, and the reason is that because it is the central government which is issuing these treasury bills, the investor or the market knows that these treasury bills will always be honored, and therefore if any investor wishes to liquidate these treasury bills before maturity, he can easily do that. Important feature of treasury bills is that they can be used by banks for meeting the SLR and repo requirements. Now SLR and repo are concepts which we will cover in detail in the topics of banking. However, right now for the context of this video, let us quickly understand what it means. So by SLR we mean that in very layman terms, a bank needs to keep certain amount of liquid assets with itself at a given point of time so that it has enough money or funds to meet the demand of its depositors, and that is called SLR. And one of the way in which banks can meet those SLR requirements is by investing in treasury bills. So treasury bills are a mechanism via which banks can meet the SLR requirements. And by repo we mean that if a bank wants to borrow from RBI, it can use these treasury bills as collateral and borrow from RBI. The final thing to remember out here is that treasury bills have a minimum denomination of 25,000 and its multiple. So you can have treasury bills for 25,000, 50,000, 75,000 and so on. So this is all we wanted to cover in the topic of treasury bills. I hope everything we've covered is clear. If you did like this video, do check out the next video on cash management bills. Thank you so much for watching.